We are back with Gareth Soloway once again, meeting on days of big news. Gareth, how you doing?
I'm good, Greg. Thank you for having me back, and it's a pleasure to chat.
Yeah. Since the last time we talked, the markets have ripped, and we had the flood of ETF applications, and then today, Gensler kind of gave them a little bit of a decoy or a little bit of a slap down there. So, what are you looking at? What's going on?
Yeah, so I mean, it was interesting. I'm not entirely surprised. It almost seems like it would be too easy for all of these big companies just to file for the ETFs on the spot market and just get right through. So I think the biggest takeaway is initially we saw Bitcoin fall sharply, right? It went from around 31,000 back to 29.5, but it's kind of come back to settle in that $30,000 range. And I think what we take away from this is that it's not horrible news. It's not great news, but it's not horrible. I think the term used was inadequate, right?
Yeah.
So that doesn't mean they're not shutting it down. They're saying we need more information, or we need you to do more due diligence, or give us whatever we need. And then it seems like they're open at least to it getting through.
Yeah, so they responded quickly, which is good. And the words they use, the filings aren't sufficiently clear and comprehensive. And the filings were being returned to the exchanges because they didn't name the spot Bitcoin exchange, which they're expected to have a surveillance sharing agreement,
Right.
or to provide enough information about those surveillance agreements. So they want them to name the exchange, which is interesting because there isn't one to name currently other than Coinbase. And with Coinbase being, a party to litigation with the SEC, I wonder if this is, kind of a gesture on the SEC's part saying, hey, we're going to respond quickly. We're going to tell you these things. But if they try to name Coinbase, they can decline it and say, well, we're in current litigation with Coinbase. That's not going to work. And, maybe deny the application based on that.
Yeah. But I think also, I mean, from what I know, with at least the legalities between the SEC and Coinbase, they're filing not with Bitcoin specifically; it's with other things. So it's with the altcoins, right? The ones that they're claiming are securities. So maybe that also leaves a small door open. I think honestly, I always look at price action, and price action has been pretty muted, right? I mean, you had the initial reaction, and let me show my chart here. But we had the initial reaction, and let me go to the intraday 10-minute chart. Here was that news hitting the market. Again, we were up right against that resistance at 31,000 on the intraday. We flushed down to support, and then we've kind of just trailed off in this lower area here. And the other thing that I thought was interesting too is that today was the day that altcoins were starting to pump. And it was amazing how that just took a lot of the wind out of the sails of the altcoins. Like, so if we go to the daily chart and you look at Cardano, for instance, Cardano was up into resistance earlier today, looking like it was trying to break out and go to this next level of 33, 34 cents. And that news just slammed it right down. So by hitting back at Bitcoin and the ETFs, they kind of took out the wind from behind the sails of the altcoins as well.
Yeah. And it's really funny because, we were looking at a big decline until the market digested the information and realized, oh, wait a minute, they're saying there's a chance. They're just
Yep.
saying, you need to clean this up, and it's not a denial. It's, they want clarification. But yeah, so it'll be interesting to see if they do approve or deny, and how quickly that comes, and how long it takes for the applicants to fix their applications, which I would think would be pretty quick. So
Yeah.
here's the question. So we know this price action is because of the BlackRock news of the filing, and then everybody else that's followed. We know that's what's pushed price up. So what are your thoughts if these things do get approved, and the next whatever, or move to the next phase of approval within the next 45, 60 days? We know it'll probably take a year to maybe 18 months before they're actually able to start trading. Do you think
Right.
we could see a revisit of lows or new lows in that time frame, or do you think we're solid now as long as it looks like these are going to get approved?
So that's such a good question too, is because ultimately longer term, there's no doubt that having spot ETFs that are brought to the market by Fidelity or by BlackRock, that's a positive. That's a net positive. But you're right. I mean, we're talking about a year to a year and a half away. The crypto market barely can focus on a week to 2 weeks away. And so how do when you talk to crypto investors, when this is so far away, do they stick around? What if, and again, this is my bear case, right, for Bitcoin. If Bitcoin is going to revisit its lows, it's not going to, in my opinion, have to do with a new fraud, a new this or new that. Even with Binance, the markets has kind of digested the chance that what the SEC has claimed is true. But the bigger question is, if you look at what's going on with the stock market and just the relentless upside action we've been seeing in certain stocks, let's say we do all of a sudden get a corrective move in stocks of 10, 20, 30%. How does that then affect Bitcoin and the crypto markets if you see a run for safety? Because I don't think at this point yet we have Bitcoin is certainly not a safe haven yet. All right. We saw a little bit glimpse of that during the banking crisis earlier this year, but it's really still been trading as a risk asset.
Yeah. So that was going to be my next question. So yeah, it's a risk asset. If markets go down, Bitcoin's going down. I mean, it's just what it is. It's what it's done, and it's what it's going to be. And that's without an approval of an ETF. Now, let's say that an approval did come, and maybe it is 6 months, 12 months down the year, because it may take that long for the bear market to continue to play out and retest lows.
Right.
In this environment right now, because I mean, economy is still good, GDP is growing, jobs are good, inflation is still a little bit high, but the Fed could they could pause again at the next meeting based on the data that we just received and the ability of the economy to withstand the rate hike so far with very little movement. Although inflation's come down, but nowhere near where they want it to. But they haven't affected the labor market. They haven't really affected the economy at scale, because I mean we still have growth, people are still spending, people are still employed, and as long as they're employed they're going to spend. But all that to say, let's assume we do get an approval and then the market tanks. Do you think Bitcoin can hold up at that point?
And to me, that's where I personally don't think so, because again, if there's one thing, the COVID tank, and again, that was a black swan event. It caught everyone off guard. But one of the things that I remember vividly from that period, as well as past really panicky sell periods, is that even gold sells off for short amounts of time. And so I think people have to realize that even if you get to be that panicked market, that everything is going to dump. It's people just freak out and they just dump all asset prices, even if it's something like gold, which is a safe haven, at least in the short run. So that kind of opens the door for maybe a buying opportunity if that happens, even if a spot ETF has been approved at that point. And let's not forget that the top on the last cycle was exactly when the futures ETF got approved. So here we see that certainly it wasn't like all of a sudden that was the new bull market. That was actually the top of the bull market when that happened.
Right. And this where we're dealing with now, this market could play out for another year before we, fully understand a direction, whether we're still in a bear market, whether we've claimed a new bull market. I mean, it could range for a year before we even know where we're headed.
Yeah. And I think one of the things, I mean, so there's some things that I'm seeing in these charts. And so this is the 10-year yield chart. And what we had was a wedge pattern that was a bullish wedge pattern. We broke out yesterday with that solid economic news that we got, the GDP revision to 2%. And then today we had the slightly better than expected PCE number, which kind of brought back in from this next resistance level, which is what to be expected, right? We broke out of the first one, but the second one hasn't been tested yet. It has to pull back. But this is the key, is that are we going to see a bigger breakout on yields if this channel, see this beautiful, this is actually a bull channel. In fact, it's very, very similar to what we've seen on gold play out over the last 4 years or so, the same pattern formation. And if this starts to break above this line, you at least are headed back to 410 and then maybe the highs of 436 on the 10-year. And the question is, the higher rates go, what do risk assets do? That's the question I have. And I think also what's concerning to me is the divergences that we're starting to see. So if you look historically at the 2-year versus the stock market, or the 10-year versus, there's a very clear kind of coordination between what goes on there as well as the markets. And we've seen a divergence over the last, so long, let's say the last 6 months, in the market with these signals. So something weird is going on here, something that is unsustainable if you look historically at the markets and at these other signals. By the way, another signal that I pointed out recently was M2 money supply. So M2 follows like every up and down in M2. Well, there's actually honestly been no downs until recently in M2, but you can see the vertical nature of M2 as it climbs. And in fact, let me see if I can bring this up here so we can all kind of take a look. But as M2 climbs, the market has always climbed. And let me go to the S&P 500. And then let's bring up the M2 money supply here. Let me break this up here. Let me see if I can follow. There we go.
Yep.
So what we can see here is if we go, and I can zoom, and I want to zoom out for everyone to see this, is that if you coordinate this with COVID, there's COVID and there's your money supply increase. And then look at the run as money supply goes up. Then look as money supply flattens and starts to decline. We have this. The problem is that this action here is down money supply while we have been rallying. And that, again, is problematic. That tells me there's something brewing here in the markets. And it may not play out for the next 6 months. We don't know. But at some point, there has to be a revision back in the markets or in money supply to some central point.
Scroll back on that to 2008 and see what it looks like compared to 2008 money supply versus markets. That'd be interesting to see. And, while you're doing that, yeah, I mean, that's been my thing. Is, the reasons the markets, are doing what they're doing is there's still just so much liquidity in the market still that hasn't been sucked out. The Fed hasn't really done a whole lot to their balance sheet. The Treasury, spent all their money. I mean, that's, the Fed or federal government doing infrastructure spending and Bidenomics, pumping trillions into the economy. I mean, there's so much liquidity. And don't forget, the way the markets are running right now and taking profits, I mean, that's liquidity generation as well. And I mean,
Yep.
I've doubled my account this year so far. So I mean, there's a ton of liquidity in the markets right now and on the sidelines still waiting to go in. So I mean, I think this could take a while to play out. But look at that. That's interesting, 2008 and 9.
So you can see this little bit of an uptick here in 2008 and 9, where money supply started to pop. And then we got this follow through in the markets where all of a sudden the markets popped. And then you can even see the matchup over here where another little blip up in 2011. And then that leads us, after this collapse down, into the next bull run in the markets up. And so, by the way,
to your point, the money supply was still increasing while, while the markets were going up. This time you've got, M2 divergence.
Right. And I think you're right with that. I think, at least from my perspective, the divergence can't last forever. At some point, the markets have to come back in. But I do think that there was so much money on the sidelines because investors were so worried about a hard landing. And now everyone feels like they missed the boat, that they're all chasing. And that's creating this divergence where people are saying, hey, listen, we're going to have this beautiful soft landing. Everything's going to come up roses. And so they're willing to kind of chase stock prices up at these levels.
Yeah. It's really interesting. And, now, I mean, people are saying, what recession? I mean, there's a narrative out there that we're going to avoid recession. It is going to be a soft landing. The Fed may not have to hike anymore and just let it play out because it seems to be working. The economic data would indicate that it seems to be working. Money supply has to drain. And that's why I'm saying what I've been saying. I've been on a lot of spaces and things lately. This is going to take a long time to play out. There's so much liquidity in the system still. And we had the Supreme Court slap down, the proposal for student loan,
that's right.
Forgiveness of the student loan debt. We've got payments kicking back in September. I don't think we're going to really know where the economy stands or where it's heading until the end of the year, Q4.
That's what I think too.
Because it's summer. People are still spending money. They're still taking trips. They're still employed. Right. But you got student payments kicking in September, Q4. You got the holidays coming that people need to start saving up for, and you kind of pulling back, which is kind of, what tends to happen. Housing market tends to cool a little bit in the fall. So, that could affect earnings of people in that business and in that world. That kind of pumps liquidity in the economy. So, I think we might have smooth sailing here for a couple of quarters, but Q4 is going to be, I think that's going to be a real tell of where the economy is heading.
That's what I'm thinking too. And I'll show you another thing that definitely is a bigger and bigger concern of mine, ignoring the trend lines, but just looking at the yields. All right. You now have the 10-year, a full 1% plus lower than the 2-year. And that, again, I mean, historically, that's something that has to raise alarm bells from investors. That, again, that if you look historically, that signals something down the road. But I agree with you. I think there's probably enough liquidity in the market to keep us from anything major until the end of the fourth quarter. But I do think we're due. I mean, either way, markets have gone parabolic. VIX is so low now that no one is expecting any issues. And that's usually when we see some issue. And by the way, last weekend, we almost saw something, right, that the market wasn't expecting, which was the attempted coup in Russia. But by the time the markets reopened, everything was all good again.
Yeah. And so that's the thing that, we discount as well, that I mentioned when I do all my videos, is that we still have geopolitical risks out there.
Yeah.
Anything could flare up at any time. What we do know is, depending on the scale of it, it'll be short-lived. Markets will sell off, but then they'll rebound once we're into it, just like we saw with the Ukraine Russia war that's going on. As soon as things kind of settled in, the market started coming back a little bit.
Yeah, 100%.
So let's take a look at Nasdaq and see what you're thinking there. I mean, we've got all-time highs in Apple, we've got all-time highs in Nvidia, and we've got the Nasdaq approaching that. I think it broke the 702 retracement today. I think it was, or maybe it was the S&P. I can't remember, but I mean, it's right there at that level where it rolled over in 2008 and 9, and it rolled over in 2001.
Yeah, 100%. And I think for the Nasdaq, a couple things to just keep in mind is you have a little bit of a parallel channel formation here, where if we drag this down, and this is kind of what we're retesting now, but what we can see here is that the low end, look at that. You have the pivot low and pivot low on the downward movement, aligning perfectly with the pivot here, pivot and pivot. So again, this is a big level for the Nasdaq. It's not to say it can't get through that level, but it is a level that I'm very closely watching to see, can we push through. Now, interestingly enough, on Apple, everyone talking about the 3 trillion valuation today, and very fairly talking about it. You can see you have a parallel channel here, and we have actually gone just a little bit above that channel. So that is interesting in and of itself. But I do want to just point out to people that Apple is above its double top from 2021 by a decent amount, but market cap wise, it's now hitting a double top. And the reason is because you've had so many share buybacks going on with Apple that the market, like if you look at the market cap of Apple, now it's finally back to the same market cap it was right back here, which again, I look at that and I say, okay, is that a double top on the chart of market cap, and is that more important? So big test next week also for Apple in terms of that double top market cap $3 trillion factor.
Yeah, interesting times. Let's take a look at gold on the double top, triple top theory. So a triple top is generally bearish, right? But you're thinking gold's going to break out?
Yeah, so usually with triple tops, so double tops are the most bearish, right? Double tops, you get the biggest pullbacks. Triple tops, you usually get more shallow pullbacks and then a breakout. So for me, it's the triple top is okay, because essentially it's what you're doing is you're hammering on a doorway. Here the doorway's forming. Here you try to break it down. It's too hard the first hit. Here's the second hit over here. Now it's getting weakened. The doorway is weakened. Usually by the third or the fourth hit of that line, it can break out. What I liked about this chart, and why I actually picked up some GDX in the Verified Investing Alerts trade signal service at In the Money Stocks, and we picked up GLD, is because this pivot to this pivot was a classic retrace to what I call the scene of the crime. It broke out, hit double top, and retraced right to that. So that is to me, that's a bullish setup where I would expect this now to climb back to those highs.
Nice.
Yeah, it's a nice chart. And again, one thing about gold is it's not a sexy thing in terms of it's not going to make you a 10x or a 5x in a short amount of time like a crypto or maybe even a stock can, but it also takes risk away to the downside. You're not really worried about gold dropping 30, 40, 50% on you.
Yeah. What was that biggest drop recently there from that March high?
Let's take a look here. So from this high to this low, 22% drop. And that's pretty dramatic. I mean, that's for gold, that's a big drop.
Yeah, that's a big drop. And that was, that's when the markets sold off. All was happening. That was the Russia invasion timeframe, all that.
Right. Yeah, the dollar, that was the period when the dollar was just soaring. If we look at the DXY here, that was when the dollar was up here at these highs. And so that's another factor to just keep in mind, is that as soon as the dollar put in a top, that was gold's bottom, and gold has rallied all the way since then, basically until the recent pullback. Now it brings up the dollar chart here too, which is very interesting because you're kind of in this tightening wedge pattern. The question is, do we break down or do we break out on this chart? And that obviously will have implications for gold, crypto, as well as stocks. Generally, this pattern is a breakdown pattern. Doesn't guarantee it, but about a 60 to 40 probability that this would break down.
That's interesting. Stanley Druckenmiller is betting on the dollar breakdown. He's got, his biggest short position, I think he said, in a long time on the dollar dropping.
Wow. Yeah, I believe it. I think that's again, we've heard so much about the de-dollarization aspect and more about it. I think for me, it's a very longer term play where, the dollar will break and then it will go down, but it's not as volatile, obviously, as what we're used to with crypto. That's for sure.
Yeah. Cool. So are you still in the camp that we're not going to see, all-time highs in any of the indexes in 10 years or so? You think we're still on that pattern?
I still am. And I'll tell you why. And I'll show you a couple cool charts here that just kind of exemplify that. Now, listen, the way I'll be proven wrong is that if we basically take out all-time highs in the next month, 2 months, 3 months, well, then I was wrong, no doubt about it. But one of the things that I want to show you here, and I'm just going to remove these lines so we kind of clarify and keep it as simple as possible. These are just some former trend lines. But take a look at this. This is actually something fascinating and just going to more price action. So if we take the high, the all-time high, to the low, it was a 37, almost 38% drop. If we take the low to the high, it was currently, let me see here on the Nasdaq NDX. Oh, this is the Nasdaq 100. I want to use the Nasdaq composite because the Nasdaq 100 is too highly weighted to the big stocks. All right, so there's that same line there. So if we take again that high to the low and we drop it down, 37.5%. If we take it back to the high, 37.5%. So you drop 37.5, you rally 37%. So 37.5%. Now, let's go back to the dot-com bubble. And I want to just give you an example of this. And by the way, I'm not trying to draw a parallel necessarily and say that we're in the same sort of thing. Although granted, back then, the Nasdaq didn't make a new high for 15 years. But look at this, 41% drop from peak to trough, then a 41% rally before the bigger rollover occurred. And so again, by no means does history have to repeat.
Well, look at 2008.
Yeah, 2008, it's similar, not quite as much. But remember, 2008 was more a banking situation versus a tech situation. But if we go to 2008, let me see here on this, 2003. So this would be this high and then this bounce. Let's see what we get here when we do that. So this dropped 23%, rallied about 18%.
Yeah.
So my point again is looking at these charts, you have to understand that even in bear markets, you get these incredible rallies that make everyone believe there's a new bull market. And let me just show you one other thing just for the heck of it. We're going to go to the Dow Jones Industrial Average, and we're going to go back to 1929. So we're going in our DeLorean and we're going all the way back. In that period here, let me move that down.
That looks just like the Nasdaq in 2001.
Doesn't it? 50% drop, 52% rally. So almost identical drop, then rally. And then we all know what happened after that. From that point on, you fell. Let me see how much we fell from that point there. To the lows, you fell another 86%.
Yeah.
So again, so I guess my point is that this is not uncommon in big cycles to see rallies equal or even slightly greater than the drop initially in the markets before the next leg down. And what's interesting is that it almost makes sense that if you and I both agree that late in the year, that's where there could be some trouble. Could it be that we kind of just go sideways to up a little bit more until late this year, and then that's where that kicks into the downside? I don't know. I like just pointing out cool things on charts.
Yeah, and I mean those are fib levels too. I mean that's probably the 702. Most of those levels are probably retracing back to the 702, 618, somewhere around there. That's probably
this was the 50% retrace right here. Yep, perfect.
Yeah, but where we're at right now on the markets, we're at that 702, 618 level on several of the indexes right now, and those are huge levels. They're technical levels, they're psychological levels. But yeah, I mean, this is just what markets do. And if all things being equal and nothing happens, geopolitically, credit markets, banks, whatever, if we keep humming along like we are now, I mean, this could play out till, end of the year before we start seeing any kind of, direction. It could just range.
And then and you're dead on, by the way, on that 618 Fibonacci retrace. That's where the market topped a couple weeks ago.
Yeah. Yeah. So, I mean, that's,
right
if it's going to roll over, that's where it's going to do it if it doesn't get past it.
I agree. I actually do agree with you. It's very rare a market goes up to the 786 and then, it may pull back there, but then oftentimes it'll make new highs. It's the 618 that if you have a bigger move down coming, that's where it stalls out. So we actually may know in the next few weeks, really, what's going to happen here.
Yeah, that's what I've been watching. Cool.
Very cool.
Well, Gareth, I appreciate you taking some time out. Tell everybody where they can find you. I know you have some fantastic courses. I went through them. I doubled my account this year.
Nice,
So
buddy. Wonderful to hear. Man. That's super cool. So yeah, people can check it out at the courses are at Verified Investing. It's called the Winning Trader Series. Right now, we're offering 35% off for July 4th sale. So it's a steal of a deal. 20 hours, 3 courses, 20 hours long. Everything I know. All this stuff you're seeing before me that I'm using, it's all in there. And I do encourage people to check it out because learning is the most powerful tool towards ultimate financial success. And I'm sure you would agree with real estate, everything you've developed and learned in real estate, now you utilize to make money for the next 20, 30, 40 years, the rest of your life, whatever that may be.
Once you have the knowledge, they can't take it away. That's
right.
It's infinite returns on that education. And yeah, I mean, I'm a big proponent of education. I talk about it all the time. And, I'm a lifelong learner. That's how I've been able to do what I did in my career, starting with nothing, no money, no formal education. I didn't even go to college. I went to high school, went in the Navy out of high school. It was all through self-education, personal, professional development. And I mean, to this day, I just keep soaking it in. I took all your courses. I learn everything I can all day long, every day. Doesn't make me right all the time, but it sure gives me a lot of advantages that I wouldn't have had otherwise.
Right. And remember, in the market, especially in stocks and crypto, you're against other people, right? So what you need to make sure you are doing is being just better than a majority of people, which should mean that you win a majority of the time. Like you said, you're never going to win all the time. That's impossible. No one can do that. You just want to win most of the time.
Yeah, absolutely. Well, Gareth, thanks for being here today, and have a happy 4th of July weekend.
You too, buddy. Take care.